Let's now take a look at how the markets are faring. The rand is steady this morning after hitting a one-year low against the dollar yesterday. Meanwhile, global markets have already started trading on a mixed footing. For the latest market developments, we're joined now by Chantal Marx, Head of Equity Research at FNB Wealth and Investments. Chantal, very good morning to you. Thank you so much for your time. Talk us through how the markets have opened this morning after ending the last session slightly weaker.
The markets are actually looking quite good this morning. We see that they are trading up globally, and the JSE has followed suit. I think that the market is now trying to figure out whether or not inflation is as big a threat as they thought. Of course, if inflation is threatening because it results in higher interest rates. But if the economic recovery is strong enough, it should be able to withstand those increases in interest rates. And that's kind of the debate that's happening right now. And it seems as if this morning globally, the debate has settled on growth is strong enough to withstand increases in interest rates.
Now, both Moody's Investors Services and S&P Global Ratings are set to give reviews of South Africa's credit rating later. Does South Africa look any better since the last review?
Yeah, South Africa actually does look a lot better, but it has been mainly due to higher commodity prices, which has really improved the earnings prospects in the mining sector. That in turn has resulted in higher taxes and royalties paid into the fiscus. So it seems to be a temporary effect, and I think that if you look back at the MTBPS last week, the Minister of Finance echoed that, and that is why he didn't make any permanent changes to spending because of this windfall. So some of that windfall actually went towards paying down debt slightly, so things look a little bit better. That said, in the absence of meaningful structural reform, we aren't going to get the growth required in order to get us out of this debt hole that we are still in currently. And because this windfall from the mining sector isn't permanent, this is actually just delaying, I think, another credit ratings downgrade in the next year or two in the absence of these structural reforms.
Those numbers looking like?
I'm so sorry, I missed the first part of your question.
I was asking you about Tiger Brands having audited the results and dividend declaration for the year ending 30 September of this year, and really just trying to get a sense of what the numbers look like.
So the numbers actually look quite solid, and I mean this is on top of civil unrest and everything else that we've been seeing through the period. They also didn't do as badly as some of the other industrial counters on the JSE through the hard lockdown. Of course, people were still eating at home, and this would have benefited the likes of Tiger Brands. So with that in mind, they actually performed quite well. The results were also very well guided for. So if we look at the market reaction, there really wasn't one. And yeah, I mean, revenue growth of 5% for a company like Tiger Brands, as large and complex as it is nothing to frown upon.
And how is the Massmart Group share likely to fare amid the nationwide picket by Sakau?
It's actually interesting. I've been looking at the retailers this morning just because Pepkor also released results, and it's very mixed. So it's very difficult to say what exactly Massmart's share price reaction has been, but we'll have to see how long this thing drags out. If it's going to be prolonged and if it's going to impact trading, then it will have an impact on the share price at some point, especially once we get a better idea of what that impact would be on sales. If it's concluded quite early, I think that the impact will be quite limited. Again, the conclusion also makes a difference, because if it's concluded because of much higher wage increases, then that could have a negative impact on the share price because of the expectation of high costs going forward. If it's concluded and wage increases are within expected ranges, then I think you'll probably see a positive share price reaction.
Very well. Thank you so much for that chat. Of course, Chantal Marx, Head of Equity Research at FNB Wealth and Investments.